Hey, 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 welcome back to the next video in this series. Don't worry, retire happy. Step 4. Today, we're going to be talking about how you should invest your portfolio during your retirement years. I know that this is sometimes a touchy subject for people because many times I work with retirees who are completely risk averse and they don't want to have any of their money in the equities market at all. And so then I have to really make sure that I take a few minutes to educate them on this next part, why it is so important to keep a portion of your money invested in the equities market in order to protect your savings from inflation. Because you have worked 30 or 40 years, you've worked so hard to save and invest for the future. And we don't want to get into a situation where your savings are, where they're sinking, where they're drowning, where they're swimming with the fishies, right? Inflation can have a dramatic impact on your future purchasing power. So, what is inflation? Well, we know that it can decimate your purchasing power over time. And it's very problematic for retirees who are on fixed incomes or depending on retirement savings to help make ends meet. In other videos, I've extolled the virtues of guaranteed lifetime income from sources like pensions, Social Security, and income annuities. But we don't want to rely our entire retirement plan just on fixed income sources. Inflation will destroy the purchasing power of those sources. We must have some tools in our arsenal to combat the effects of inflation. And so this is where stocks fit. This is where bonds fit. This is where real estate fits. This is where managed money fits. Now, the good news is that the U.S. has experienced a period of relative price stability over the last 25 years or so. They tell us that we have low inflation, although it seems like the cost of things are actually going up all the time. Some much quicker than others, like college and medical expenses, things of that nature. Now, and I don't say this to worry you, but it is something to take into consideration that there have been some periods in time, such as the late 1970s, when inflation has soared into double digits. We have to have a plan to combat this very real risk of inflation decimating your purchasing power. So what I'd like you to do is I have an example on your screen. And with that orange horizontal line, I would like you to please look for 4%. And I want you to now imagine that we have a retiree. They're living on $10,000 of income per month. Okay? At 4% inflation, now I want you to just scroll right down that graph, find the 20-year mark, and you will see that at 4% inflation, it has cut the purchasing power of your money in half in just 20 years. Or said another way, you'll need twice as much income just to maintain your same standard of living. This is absolutely devastating for a retiree on fixed income. So, what's the answer? We need to save. We need to invest. We need to grow our money and accumulate resources for the future. Well, how do we do this? Well, earlier we talked about guaranteed income sources. Again, like I said, pensions, Social Security, income annuities. But this is the part of the strategy where we need to invest and try to grow our money for the future. My advice, work with a trusted investment advisor like myself to grow and protect your nest egg to offset the effects of inflation. So, investing in the equities market, it's a fantastic way to accumulate and grow your wealth. But it's not always all sunshine and rainbows. Okay. You see the cartoon on your screen. Why dabble in the stock market? You can lose your money at the casino just as easily. Plus, the drinks are free. Look, we're not going to let that happen to you. But before we move on, we do need to talk about some of the risks with investing in the stock market. And more importantly, how intelligent, comprehensive retirement planning can mitigate those risks as much as possible. Let's start with market risk, or the risk that your investments may lose value. Many people believe the older you are, the more conservatively you should invest. But in reality, the riskiest time to invest isn't when you're 87. It's when you're 57 or when you're 67. It's that 5 or 6 years before you retire, that range to 5 or 6 years after you've retired and have begun receiving retirement income. It's that yellow rectangle on your screen. Prudential dubbed this the retirement red zone, and they were absolutely right. So if you were to ask me, Ron, when is the riskiest, most critical time for a retiree when they should really not mess anything up? It's right here. If you want to pick a time in your life to not lose money, that period would be the last 5 years before retirement and the first 5 years of retirement. If you are in the retirement red zone, a big market decline, like we saw in 2000 through 2002, and then again in 2008 and 2009, that could be devastating to your retirement savings and your future retirement income. So why is the retirement red zone the riskiest time? Well, it's because of something that's called sequence of returns risk. I'm going to teach you a concept that's going to be a complete paradigm shift. And it goes against what most financially savvy people have experienced. Because for their whole life, they've been a saver and they've been an investor. They've grown used to checking the average returns on their IRA, their 401k, their stocks, their bonds. And if they can get a 5% average return, that's better than a 3% average return. And if they can get a 7% average return, that, of course, is better than a 5% average return. And so people grow up thinking that average returns are what really matters. And during your working years, it is. However, when you retire and enter the distribution phase, the rules of the game change completely. Average returns no longer matter. What matters much, much more is the order in which you receive those returns. The bad news, that's completely outside of your control. Look at the graph on your screen. Both portfolios shown have identical average returns of 6.3%, but very different outcomes, right? What's the difference between these two portfolios? Well, the red line shows a portfolio that lost money early in retirement, and you can see that it devastated their retirement. The blue line shows a portfolio that lost money later in retirement, and that had much less of an impact on their overall retirement outcome. Again, this isn't anything that you can control. If you were to retire, and then just bad luck, the market crashes the following year, that's out of your control. But if you have to continue to withdraw from that account during a bear market, it's absolutely devastating because it's like a double whammy or a double negative. You have market forces pushing down the value of your assets, but you're just exacerbating the problem because you're withdrawing money from a depleted asset, which is the worst thing that you can do, by the way. But you're selling at a loss, and you're locking in those losses by selling. Your portfolio will never be able to recover. And then what happens, because you've depleted the account so much that when the market does start to recover and it enters the positive growth phase, you don't have enough money left in the account to take full advantage of the compounding interest or the good volatility of the next bull market. Again, this graph, same average returns, very different outcomes. This is the sequence of returns risk. The only way to remove sequence of returns risk is to plan for it by working with a retirement specialist who knows how to plan for it and how to neutralize it. And then finally, I'd like to conclude the discussion of market risk with this very important concept regarding retirement income, and that is withdrawing too much money from your investment portfolio. Generally speaking, this is what I find. When people come to me, they know how much money they have. They know it's in their brokerage account. They know how much they have in their IRA or their 401k or the cash value in their life insurance policies. But many people don't have a good idea what they can actually expect from that money as far as spendable income. You know, there was a study done not too long ago by MetLife. And that showed that nearly half of all baby boomers think that you can withdraw up to 10% of your retirement savings out of your account every year. And you would just run out of money real fast. Now, the Wall Street Journal had another article that identified the bulletproof withdrawal rate for a diversified portfolio. If you were to make a guess, what would you say? 5%? Wrong, too much. 4%? Well, even 4% withdrawal rate fails 20 to 30% of the time now. So what is the bulletproof rate according to the Wall Street Journal? Only 2%. 2% is the bulletproof withdrawal rate, although 3% is considered relatively safe. Alternatively, 4% is pushing it, and with 5% or more, the person will probably run out of money. It's just a matter of time. Most people have no idea how dangerous it is to withdraw too much each year. See, after longevity risk, withdrawal rate risk is one of the biggest challenges that people will face in retirement. Now, let's consider this example. So what does this actually mean? Okay, a 3% safe withdrawal rate. Well, that means if you are one of the lucky people, not just lucky, but you worked hard, you delayed gratification, you had long-term vision, you saved, you invested, and you were fortunate enough to accumulate $1 million in your retirement account. It's invested in a well-diversified portfolio, stocks, bonds, mutual funds. You can withdraw 3% a year. So what does that mean? $30,000 of retirement income. And if it's in an IRA or a 401k, you have to pay tax on top of that money. So this is certainly not efficient, nor is it the optimal way to produce retirement income. In a subsequent video, I will talk about other ways that are much more efficient than your investment account to produce retirement income. But we want to conclude this discussion again by telling you it is so extremely important to invest your money using the help of a qualified professional, to invest your money in growth potential, in stocks, in bonds, in mutual funds, to have somebody who's going to manage that money, help to grow it for the future, to grow your wealth, to guard against the negative effects of inflation, and even as a potential legacy to leave to you and your family. So, again, standard disclaimer, these concepts are from the Don't Worry, Retire Happy book and television series produced by Tom Hegna himself. This information is educational in nature and is not to be construed as specific financial advice for you and your situation. I am not a tax accountant. I'm not an attorney. So for assistance with tax or legal matters, please hire a qualified professional in that area. Finally, the standard disclaimers for my registered investment advisory firm that I work with, and some disclaimers about the insurance business that I place as part of the retirement planning process as well. Just remember, the examples that we show, they're hypothetical. Rates can and do change often. They can depend on your age, your health, your gender, your risk tolerance, your goals, your specific situation. So what's the best thing that you can do? Contact me at the number or the email that you see on your screen to get assistance with this all-important area of life, which is investing for the long term, investing your retirement nest egg to meet your goals. By doing so, we can ensure implementing the investment plan into the overall strategy will help you not to worry and retire happy. Thanks for tuning in.